Hello, Uncle Jim here. Today I want to share with you a new strategy that I'm looking at just to make some extra income. This is not my typical strategy where I'm picking companies I want to own. This is actually a strategy just to earn income, and I'm primarily doing it with the Russell 2000 IWM. So I'm going to share with you that strategy, why I'm doing it, so far how it's gone, and at the end of the video I'm going to share with you the actual trade. So stay tuned. I think you're really going to enjoy what I have for you today. Okay, let's go ahead and get started. I want to give a quick market update. I do believe the Fed's going to hold steady next week. I don't expect an increase again. Now, if we do get an increase, I think that's going to be definitely headwinds on the market, and the market will probably go down. But I'm pretty confident that we won't have an increase. Now, it doesn't mean they won't increase in July, but I do think they're going to hold steady. And they've kind of shared that. Several of the board members have mentioned that they're going to not look at an increase and probably hold steady for June and possibly even July, and maybe do a decrease later in the year depending on what happens with the economy. Now, I do know the jobless claims were up, and there are other factors that are showing that we are slowing down economy-wise, and retail's being hit. People aren't spending as much money, and people are hurting out there. I've heard repossessions or repos are way up. I also have heard that I think Dollar General said that they're finding that a lot of people aren't shopping there. They're going to food pantries. So I do believe we are seeing a slowdown, and that makes me feel pretty firm that the Fed will hold steady. And I do think we're going to kind of tread sideways. I don't think we're going to have major up markets or major down markets. We may have small bumps and go down at other points. I don't think we're going to retest the lows back in October, but I don't think we're going to probably get into a full-blown bull market. So with that being said, let's jump into the key points. So for this video, this is kind of an exception to most of my other videos and most of my primary strategy, which is picking good companies, earning dividends, wanting to use the wheel to purchase stocks. In this strategy, it's just purely income. And that's why I'm trading or working with IWM or selling options on IWM, which is the Russell 2000 ETF. I'll go into a little more detail about it at the end of the video, share with you what it looks like when you look at it in Schwab, how it's ranked, what kind of returns it has. But my primary reason for looking at it is it doesn't move a whole lot. It doesn't go way up or way down. And it's a little bit easier to trade things like vertical put credit spreads or maybe even iron condors. I played with the idea of maybe trying to do some iron condors with it. It also has lots of liquidity, lots of strike prices, a good bit of volume. It's one of the most active ETFs out there other than SPY. A lot of people will trade in SPY in a similar fashion. I prefer IWM because it's currently, I believe it's like 185, 186, whereas SPY I think is in the 400. So it's a little bit easier to deal with. It's not so expensive. So if something did happen and you got assigned, it wouldn't blow up your account. When it's $400, you're talking $40,000 you would need with SPY. With IWM, you don't need anywhere near as much capital to trade in it. So I've been looking at it, working with it to try to see if I can make some nice income with it. And so far I have. So again, at the end of the video, I'll go over the trades. For the last 6 months, I've been selling options on it. Again, vertical put credit spreads, and they've done fairly well, especially with the ability to, just generate income and not worry about wanting to own it. And I'm trading it very similar to the other options that I trade. Like I'm using the 15 delta, and it actually makes it easier to get the true 15 delta. You can find really close to a true 15 delta. With a lot of the other stocks, you might have a 12 delta, a 19 delta, and a 26 delta, but there's so many more strikes with IWM that you have a lot more choices, and you can get a lot closer to the risk that you want to trade with. And just like my regular trades, I've been doing $10 spreads. I'm playing with the idea of maybe not doing $10 spreads, maybe do $2 spreads or $5 spreads, and trying to play around to see if I can potentially do a little bit better. I've actually even played with the idea of doing iron condors, which is just a vertical put credit spread and a call credit spread. So it's like taking both and putting them together and doing that with IWM, but doing it at the 52-week high and the 52-week low. So a lot of these different ideas that I'll probably try over the next couple of months to kind of change my strategy, try to make it a little bit better, improve upon it. The other thing I thought about is doing stop losses. I'm currently not doing stop losses or limit orders, saying, well, if it's this profitable, it gets to an 80% profitability, then close it. Or if it gets to a 20% loss, then close it. So I have found that, if I do close the position and open a new one, I typically will do better. And you'll see that again in the trades that I share with you at the end of the video versus rolling. Rolling, I've found I don't do quite as well. And it may be the way I'm doing the rolls. But again, I'm playing with what's the best way to do this. Now, if you have ideas or comments or you're doing something similar, maybe with SPY versus IWM, please add a comment below and let me know what you're doing. I'd be curious to hear what works for you and what doesn't work for you. And as always, please subscribe, hit that like button. I'm a growing channel. So it's easier probably to just jump in and look at the trades, and I can share more with you on how I'm structuring these trades and why I'm doing what I'm doing and what I probably will change going forward. So let's go ahead and jump into the next part of the video, and I'll share with you the trades. So let's go ahead and jump into that. Okay, before I jump in and talk about my trades, I do want to talk a little bit about the iShares Russell 2000 ETF. And again, I don't really plan to own this, but you can see it doesn't move a whole lot. Its 52-week range is 201.99. The low was 162.50. It's currently 186, so pretty near the exact middle of the range. And if we come down and we look at, you can see it stays in this range pretty nicely. It got pretty close to 177 several times in the last couple of months. But then last year, its low was 162.50, which was right around that October time frame again. And if we switch this to 3 years, you can see it doesn't move a crazy amount. It did get kind of high back in 21, which I think was very unusual. If we go out to 5 years, you can see it did hit some unusual highs. And everything did in 21. 21 was a little bit crazy. So that's why I like the 200. You can see the line right here. It goes all the way across. And if you ignore the 20, some of what happened in 21, 200, meaning if you're using like a 201, 202, which is the 52-week high, you're staying above most of where it was going back almost 5 years. And if you pick on the low end, like 162, I think, which is pretty close to this line, you're doing pretty well. Again, it doesn't move, and that's what I've experienced in the last 6 months. I've had none get assigned to me. I've been able to trade it pretty regularly. If we come down here, now the numbers look lower because it hasn't been around as long. So inception going back, it's very similar to SPY. I think it's a little lower. The returns are a little bit lower than the SPY or the S&P 500, but it's pretty comparable. I believe the SPY might have been like 8.5, and this long term maybe more like 11 or 12%. But you can see for the year it's down, which again bodes well for selling vertical put credit spreads. And here you can also see for the 1 year, it's down almost 11%, 5 years up 4, 10 years 8. And then from inception, which was 2000, it's 7.37. So it's not that bad an ETF, but again, I have no plans on owning it. I just wanted to share with you what it looked like. And a lot of people will trade SPY. I prefer IWM again, mainly because it's $186, not 400 and some odd dollars. So if by chance something does happen and gets assigned to me, it won't blow up my accounts. Whereas, if you're doing 2 or 3 contracts and it's $400 a share, you're talking 120,000 in capital you would need if it suddenly you had an early assignment for whatever reason. So now let's actually jump into the trade. So I'll switch over to the trade. So I did 7 trades, and 5 of the trades were just in my IRA. And then 2 of my trades I did back in April, which were just in my Roth IRA. So all the trades I've done have been in my retirement accounts, and I've done fairly well with them. So the first one I started back in January, and this one closed. So I didn't roll it. I actually closed it once it became very profitable, and it was, again, a vertical put credit spread, 160, 150, expiration 217, brought in 186 in premium. So the required capital was 1813, and yearly ROI is over 206%. Now that's partially because I closed it early. I closed it, at 123. So I literally only had it open for 18 days. So that's why the return was so good with it. So, and then my second trade I did on 119 right after I had closed the other one. But I've had multiple going. Like I typically in this one account have 3 now, but I kind of added to them as this became profitable. So this one also was closed early. And this one was a little higher, 165, 155, I believe. IWM, or the Russell 2000 ETF, did go up. It was a 15 delta. I forgot to put the delta in with the spreadsheet when I was looking at it. So again, very close to a 15 delta, just slightly over a 15 delta. This was expiration in March. It was $150 for the premium, $150.79. Again, the required margin, it's just 2,000 minus the 150.79 is how I'm coming up with that. And then this one, I only owned for 15 days. So I actually closed it on February 3rd. So these I did really well. You can see the yearly ROI are probably the 2 best I've had almost on any of my trades. Next, these are the ones that I still have and I'm still rolling. So the first one I did back on the 25th of January, I did a 165, 155, a 16.57 delta, so slightly above a 15 delta. It was expiring in April, so I was beginning to go farther out. And this 558 is just all the rolls combined. So I've rolled it a number of times. I've actually got a different page. So before I go into these details, let's jump over to the rolls. So for this one, the first time I did it, 165, 155, expiring on 421. Then I rolled it. I had made 203. Then I had lowered it from 165, 155 to 163, 153. And I did an expiration of 616, and I picked up another $164 in premium. So you can see I was slowly lowering it, mainly because at that time, I believe, IWM got right at 170 or slightly below. So the 165 was pretty close to the money at that time. Then I kept the strike the same because it was still like an 18 delta when I had the opportunity to roll it. So I rolled it again on 6.5. So literally earlier this week I rolled it, picked up another $190. And then so for those 3, or the initial trade and then the rolls, I made 558 total. So if we come back, that's where I'm getting the 558, and I'm just using 2,000. I don't know. I didn't think the calculation would be correct if I subtracted the 558 from the 2,000. But this is like a 45% return for this whole period of time that I've owned it. So it was a multi-roll with 3 trades. So the initial trade and then 2 rolls. And currently it's way out of the money. I may end up closing it early. So that 45% it's still open, but I'm thinking I could close it early, which would increase that return on investment, because it's based on, I believe, what is it? Let's go back over here. Yeah, 915. So that percentage is based on expiring in 915. So it's using 233 days. So I'm thinking I probably could close it, if IWM gets anywhere near 190, I could probably close it. And the way it's been going lately, I think it got up to 187 yesterday. I should be able to close it early. So this would be higher. So let's come back. Let's look at the second group of rolls. Again, in the same account, my IRA, and this was 170, 160. So this one was a lot closer to the not strike price, but the actual stock price or the ETF price. So 170, 160, again, a 16, higher than a 15 delta, 16.57. This was originally expiring on May 19th. And again, just like the one above it, we'll have to jump over here to the rolls. So this one, I rolled it on 214 out, or this was an original trade, 197.40. And then this was the roll that I did on May 8th, and I rolled it out to 7/21, July 21st. And between these two, I brought in 364. And just like the previous one, this is based on the expiration, 157 days, which is July 21st. And that's how I came up with the 42% return. So again, if I close them early, and I'm thinking I should be able to, but you can see I also lowered these. So they were 170, 160 when IWM got almost, I think for one day or part of a day, it did get in the money. I rolled these down by $2, and out from 519 to 721. So, and since then it's been out of the money, and right now it's fairly profitable. So, and this little notice just relates to the fact that the 42% will probably be lower, especially if I can close it at a decent price. This is the 42% relates to if it expires outside the money. And then let's go to the next one. This is my multi-roll 3. Again, vertical credit spread 160, 150. Again, I started going with lower strikes, which reflects in the delta. It's a 4. This one is lower than a 15 delta, so that's why it's 160, 150. Expiring on 6/16. So this is another one that I've recently rolled. It's brought in $370 between the initial trade and then the roll. Let's again go back over to the rolls. So here I did 160, 150. That's the original one, 195.40. Then I rolled on 5/31, which I believe was last week. I picked up another 174. Together I brought in 33,732. And then this expiration is based on this 8/18. So again, it's like the other ones I mentioned, since it's currently open, but being this one at 160, it's $26, $25, $26 outside the money. So again, I can probably do better once I do close it. If it expires on expiration, then that's where the 39% comes for the yearly return. So now we'll come back over here, and here, actually, is it showing a little lower? Well, that's rounded and this is not, so it's 38.6%. And again, it was 2 trades. So now I decided, because this was working out fairly well in April, I decided, well, I want to do more of these. So I opened up one in my Roth IRA at 163, 153. And this one, I believe, these two I also closed, so I didn't hold them all the way through. And I forgot to write down the delta for that, sorry guys. But I brought in $190. Again, the 1809 is just the 2,000 minus the 190, which gave me almost a 60% return. and I closed it 6.6. So I closed it literally this week. Today's the 8th, so what was that, Tuesday? So I closed it on Tuesday, and a really nice return. And then over here on 418, I also did another one, a little lower, 160, 150. And interesting, I believe IWM had come down. That's why it's a 17 delta. I believe it would have been when I made the trade. So around late April, mid to late April, around that 18th of April, I believe was around the time that IWM was pretty close to the 170 or slightly under the 170 during the day. So I brought in 168 in premium, and I did a 68.7% return. And again, that's primarily, both of these are primarily because of the shortened time frame that I owned them. That one I only owned for 49 days. And then this I owned for 64 days, but closed them both on the same day. And I believe that was Tuesday. And that's when IWM got up to, I think, 186, 187. And I think they were in the low 90s in profitability. So I went ahead and closed both of them. And I think I did it for fairly inexpensive. I think it was $8 to close one. I think the actual amounts are over here. $10.60, I think, is what it cost me to close that one. And then this one, it was $8. Yeah, minus $8. So those I did not hold very long. It did quite well. So the 6-month return on all of them, when I calculate, the required funds I needed on hand, which was about 6,000, or was that 6,000? I think it was 6,000. Yeah, 6,000. And then I base it on the amount of time that I had it. It's like a 66% return, which I'm really happy with. And my original goal was to try and play more games and try different spreads and different strikes and be a little bit more creative, but I've gotten so busy. So I'm hoping in this next 6 months that I try more, may even try some iron condors and different things to see if I can do even a little better. So I added this section in comments just to kind of talk about what I've learned. So what I've learned is rolling produce lower returns. So, and that's kind of common sense. In some cases, if I hadn't rolled and had just closed them when they hit a certain profitability, I could have done better. And that's probably something I should have taken more time to do. But again, I'm very passive. I get on in the morning, I get back off. If I do a trade in the morning, a lot of days I don't ever get back on. So that's my next comment. Closing early had big impact on return. So there again, that's another idea for me to look at going forward. I definitely need to look at closing these and maybe doing, like I said earlier in the video, something automatic, so set a limit order or set, a loss order that will automatically close it once it's reached a certain return or certain loss, so that I don't continue. Again, none of these were losses, all of these, and the ones currently that are still open, I could probably close them currently for 60 or 70% return. So far it's worked out well. Doesn't mean it will always work out well. If the market takes a huge dive and goes down big time, it could impact it. Returns could be higher for multi-rolls if last trade is closed early. So again, the returns may be better once I'm, if I can close them earlier, it'll be less days. So much is impacted with a yearly rate of return based on how many days you have it open, that again, if you can close early, it can have a major impact. Smaller 52-week range for IWM, and that's what I talked about earlier. It doesn't move as much compared to if you're looking at individual stocks. They may move huge amounts. IWM doesn't move that much, and if it's a sideways market, it could potentially be a great opportunity to make good income, not just using vertical put credit spreads, but also with using something like an iron condor. So that's what I'm meaning by that. And then this I mentioned before, looking at adding a stop loss or a stop gain to automatically close these trades. And that would probably help. I probably missed some opportunities to close them at the most profitable times and open new trades again at the most profitable time. So this is it. This is what I've done. I'm going to continue to do it. I'm going to play more. Now, I'd be curious to hear from you guys. What do you think? What should I try? Please add comments below on if you're doing something like this, or if you see something I'm missing, or maybe, should I do smaller spreads? Should I? I'm playing with the idea of doing an iron condor, but doing it at the 52-week high and the 52-week low with maybe $5 spreads on both sides. So I'm playing with that too. And then I'm also want to set up more complicated trade again to close it when it's profitable, or close it when it's a losing trade. So I hope you enjoyed that. As always, I hope you have a wonderful day. Bye-bye.